Hello, friends. Welcome back to my YouTube channel. And today is a very interesting topic that I bring for you. This topic is recession fear. Everywhere we hear news about layoffs, we hear news about war, and most of the time there's a lot of uncertainty around. And we tend to go in the zone of fear. We don't know what holds for our financial future. To overcome this, I'm going to share with you this very interesting mental framework to protect your investment. And mind you, this is a framework, this is not a forecast. Please exercise your own intelligence while implementing this framework in context of your goals, your responsibility, the finances that you have, the backup plan that you've created. Take all of those into context while implementing this framework. So I would say every day we hear this and the headlines are loud. Oil price have surged because of Middle East war and markets are jumpy. One day they are up, other day they are down. It's creating a lot of emotional pressure. And your brain is already writing an emotional resignation letter. Like, I cannot handle all of this volatility. It's too much. Because every day the news that you come across is that US is near recession, inflation is high, it's increasing, or there's no growth. The basics would be basics of life would become more expensive, energy costs would keep rising, the consumer spending is getting weaker. So all of this really bogs down our life and it becomes very scary to make even small financial decision. So I would say भाई picture अभी बाकी है मेरे दोस्त. Your portfolio does not need a thriller. Your portfolio needs a stability where it can grow and thrive and protect you in your life. So first understand why recession fear is in news. Oil prices have surged because of Iran war and Middle East conflict. There's a supply disruption, which has led to fear. And there is this classic recession ingredient: high energy cost, high inflation pressure, and weaker consumer spending. So there are a lot of news articles that reports that US recession risk estimates are almost 30%. US is a global superpower, and if that country is getting impacted because of any XYZ reason, then the whole world would be impacted. Even Indian policymakers are reacting to higher crude price, macro uncertainty. RBI has projected inflationary pressure for 27, growth estimates of around 7%, highlighting war oil risk. The fear is not coming from nowhere. The fear is everywhere. And more noise translates into more volatility. So let's understand a mental model which is ruin proof barbell strategy. A recession does not have to ruin you, but the leverage, panic selling, no cash buffer can ruin you. So the model is simple. Build a barbell portfolio. The barbell portfolio is a two-sided portfolio, and side A is a protection, so you don't get wiped off in this high volatile situation. And side 2 is a growth strategy. This lets so that the things that let you participate if market recover. Most people mistakenly do the opposite. They need no protection and they go all in into high return. It is like driving fast with no seatbelt and calling it a confidence. Most people get it backward. So what happens? They have a weak protection, most people. They take high risk bet. They have a hope-based strategy. That's not courage, that's fragility. And this fragility impacts your emotional health. So let's discuss how to build a portfolio that will help you to protect yourself, at the same time will help you to participate in your growth. Side A, the protection side. Let's look at the rules on protection side so that you don't get wiped out. The rule one is liquidity is not boring, it's your power. If the recession scares you, cash isn't lazy. Cash is optionality. It stops forced selling. Keep an emergency fund of around 3 to 6 months of expenses and keep it separate from your investment. If your income is unstable, then have a longer duration of expenses in your emergency fund. Because if you're forced to sell in a downturn, you lock losses and miss recovery. If your emergency fund is inside stock market, it is not emergency fund. It is a surprise fund. And the surprise can be upside or downside. And here, the goal of protection fund is to protect you from any downside. Now let's look at rule number 2 on the protection side is to remove fragility. Stop doing things that breaks in stress. The fastest way to destroy a portfolio in a recession scare is to take leverage, to do margin trading, to borrow to invest, to be in a mindset that I will recover these losses quickly. But that does not work. What you need is a no margin trading, no borrowed fund for investing, no personal loan for investing, no EMI option or no EMI in your portfolio. Because even those central banks are talking about stagflation type of risk, which is slower growth and high inflationary pressure due to oil shock. This is exactly the kind of environment that punishes fragile portfolio. So if you borrow money to invest, your portfolio is not investing. It's doing the stress internship. Borrowing to invest is almost like doing a stress internship. Now let's look at rule number 3 on a protection side. Rule number 3 is recession proof your behavior, not just yours. In downturn, your biggest enemy is not market, it's your reaction. So your reaction to panic selling, to stopping SIPs, to checking portfolio 20 times a day. What you need is monthly review, not daily. A 24-hour pause before any sell decision, unless it's a genuine emergency. Decide rule before volatility hits. Because daily checking is not being informed, it's emotional cardio. So it's time to ensure that you are protecting your behavior from recessionary habit. And also protecting your emotion. By not checking your portfolio on a daily basis, you are protecting yourself from emotional cardio. Now let's look at rule for growth side. So to summarize, the 3 rules that we look at protection side were liquidity is not boring, remove fragility from your portfolio, don't stop doing things that break into stress. And third is recession proof your behavior, not just your asset. On the growth side, I would say rule number 1 is keep the long-term engine running. Recession don't send you an invite card. Market recovers when you least expect. Even in current news flow, strategists are still constructively long-term. While cutting targets to conflict-driven uncertainties, volatility now may or may not stay ever. But this is not the end of equity forever. What you need to do is to participate in the game, stay invested with the right stock. Keep your long-term money in a diversified equity exposure so that you are protected from any downside. Continue your SIP if your income is stable. This is a barbell point. Protection helps you survive. Equity helps you grow. Let's understand rule number 5. Rebalance like an addict, not like a hero. In fear period, your equity may fall and your allocation may drift. So if you have a target mix like debt equity, rebalance slowly back and forward, taking into consideration your financial situation, your goals, current market dynamics, your liquidity needs. And rebalance it like an adult where you take that a conscious decision. Don't do dramatic all-in moves. Because rebalancing is a financial version of cleaning your cupboard. No excitement, but the life improves. What framework says to do now? Now, with considering the current headline and the recession news, what the headline suggests and what you have to do in a simple tip. So the current headlines are oil shock, inflationary pressure, growth uncertainty. Now, how to protect your portfolio? How to ensure that your portfolio is ruin proof? So first, top up emergency fund if it's weak. Stop leverage and reduce fragile bets. Don't exit long-term core because of scary headline. Increase discipline, monthly reviews, not daily panic. Rebalance instead of guessing what. Here, I'm going to share with you recession checklist. And I would really urge all of you to screenshot this. Look at this question on a regular basis when it comes to rebalancing your portfolio. First result. If my income stops for 3 months, am I okay? Or do I have a health insurance sorted out that won't wipe me out? Do I have any high interest debt that will explode under stress? Am I using leverage anywhere? If market falls 25%, will I continue my SIP? Do I have plan for rebalancing? Can I avoid daily portfolio checking? If you can't answer yes to most of this question, your next step is not to find best stop. Your next best step is to make your portfolio unbreakable. The recession fear may come and go. Will you still be sending when fear ends? Picture अभी बाकी है मेरे दोस्त. Don't let one scary scene make you walk out of the theater. Let me know which Babel side is the weakest for you right now. Is it emergency fund? Is it debt or leverage? Are those behavioral habits? Or it's about allocation and rebalancing? If you know any of your friends struggling, do share the video with the people who would benefit out of this video. Let me know in comment section below what are your key learnings from this video, and I would love to read each of those comments. In case you have a specific need, let me know. I will create a video for that too to help you in your journey. Thank you so much for watching this video.